Welcome to Iron Financial. If you want to forge a stronger portfolio and cut through market weakness, you know what to do. Hit subscribe right now. Let's just dive right in, because the market is absolutely roaring right now, and we need to separate the real, foundational signal from all the noise. Today, we're tearing down the ultimate industrial bellwether, Caterpillar. Cat's stock has been on an absolute tear. We're talking about a massive 44.9% year-to-date surge. Seriously, think about that for a second. We're looking at a nearly 100-year-old heavy machinery company, a maker of literal yellow iron, and Wall Street is currently treating it like some high-flying Silicon Valley tech stock. But the big question we have to ask today in this explainer is simple. Is this blueprint structurally sound? Is it built on a fortress of undeniable demand? Or is this a cyclical trap just waiting to cave in on retail investors? Market skeptic? Exactly. That's the million-dollar question. Because I'm looking at this massive 45% run-up and I'm asking, is this actual boots-on-the-ground growth, or is it just temporary hype fueled by dealers desperately restocking their yards after years of supply chain bottlenecks? We're going to stress test every single metric today, because when you're paying a 45% premium on an industrial stock, you absolutely must demand perfection.
And to start that stress test, look at the explosive number that just hit the wire. $8.17. That is Caterpillar's Q2 2026 earnings per share. Wall Street analysts had penciled in their expectations, but Cat didn't just beat them. They brought in the heavy equipment and bulldozed right over them, smashing consensus estimates by a whopping 30.72%. Now, in the industrial sector, where margins are usually ground out penny by penny, getting a 30% bottom line beat, that's incredibly rare. It's the kind of beat that forces institutional money to completely reevaluate their entire position on a stock. Look, it's a massive beat. There's no doubt about it. It grabs the headlines, the algorithms immediately buy it up, and everybody cheers. But one single quarter does not make a foundation. As an everyday investor, you have to look way past that initial pop. We need to see how this growth is actually compounding sequentially before we declare total victory here.
So let's look at how this builds from the prior quarter. Back in Q1 2026, Caterpillar posted an adjusted EPS of $5.54. And hey, at the time, that was a very solid 21.76% beat over the $4.55 estimate. Now they've ramped that all the way up to $8.17 in Q2. On the surface, it's an incredibly impressive build. But as a skeptical investor, I don't just look at the shiny new paint job on the excavator, I want to know exactly what is happening under the hood to drive this kind of hypergrowth. Are they actually selling more machines to true end users out on construction sites, or are they just squeezing blood from a stone through aggressive pricing and financial engineering? Because if it's just massive share buybacks artificially inflating that EPS number, which, spoiler alert, is something we're going to dig into later, then this foundation isn't nearly as solid as it looks.
Well, if you ask Caterpillar's chairman and CEO Joe Creed, the foundation is rock solid. Creed recently came out and stated, "Our team delivered a strong start to the year, driven by resilient end markets and disciplined execution in a dynamic operating environment." He is anchoring this entire bull case on robust end markets. His argument is that the buyers are right there, the demand is totally real, and the corporate execution is flawless.
Yeah, resilient end markets and a dynamic operating environment. That is just classic, highly polished C-suite speak. My job is to stress test that exact narrative. When executives start talking about disciplined execution, I want to see if the internal margins actually reflect that discipline, or if rising internal friction is just being completely masked by massive top-line inflation across the industry.
Fair enough. So to really understand what's going on, we have to drill down into the hard top-line metrics. Let's inspect the 2026 trajectory and just lay out the massive scale of Caterpillar's cash-generating machine. Let's talk hard revenue numbers. In Q1 2026, total sales and revenues hit $17.4 billion. That was a 22% jump over the $14.2 billion it did in Q1 2025. They drove that with a massive $2.3 billion increase in sales volume, plus $426 million in favorable price realization. And let me pause on that pricing number for a second, because that is absolutely crucial. That means they aren't just pushing more machines out the door, they are actively charging more for them, and customers are paying those higher prices without blinking. That is immense, raw pricing power. Then, they turn around and follow it up with a blowout Q2 consensus beat, posting revenues of $20.54 billion. That is raw, undeniable scale. It is undeniable scale, for sure, but we have to keep our macro context in mind here. They are comparing this Q1 jump against a slightly softer 2025, where we saw some revenue contractions and some lingering supply chain bottlenecks. But still, you're right. Consistently hitting over $20 billion in a single quarter shows they have an absolute vice grip on market pricing.
And it's not just about past performance, right? It's basically a guarantee on future cash flow. Look at this jaw-dropping number, $63 billion. That is Caterpillar's record backlog in Q1. To put $63 billion into perspective for you, that backlog is literally larger than the entire GDP of many small countries. It represents a $28 billion or 79% year-over-year increase. It even sequentially increased by $11.5 billion just from Q4 2025. That is absolute proof of an impenetrable structural foundation. Customers are lining up around the block, putting hard cash down for heavy machinery they won't even receive for several quarters.
Okay, I will absolutely admit that a $63 billion backlog is a fortress. But to really forge a stronger portfolio, we can't just sit here and stare at the consolidated enterprise-level numbers all day. We need to take the reins, rip open the specific business segments, and see who is actually doing the heavy lifting here. Because I want to know if this is actual end-user demand across every single division, or if we have localized, temporary inventory friction skewing the overall picture.
All right. Let's start with the most visible and iconic segment they have, construction industries. This is the yellow iron you see on highways, housing developments, and huge infrastructure projects globally. This is the physical heavy machinery driving these massive top-line numbers. And the metrics here are just phenomenal. In Q1 2026, construction industries saw a 38% revenue jump, hitting $7.16 billion. But here is the real kicker. Segment profit didn't just follow revenue, it outpaced it. Profits surged 50% to hit $1.53 billion. That pushed their profit margin up 1.6 points to an incredible 21.4%. For retail investors tracking industrials, seeing profit aggressively outpace revenue growth is exactly what you want to see. It signals peak operational efficiency in a sector known for really high overhead. They achieved this with $1.5 billion in higher sales volume and an extra $356 million in favorable pricing. This is absolute, undeniable foundational strength.
Hold on, let me push back hard right here, because you just mentioned a $1.5 billion increase in sales volume as a sign of strength. But if you actually read the fine print in the SEC filings, it clearly states that this higher volume was primarily driven by the impact from changes in dealer inventories. Listen to this. In Q1 2026, total dealer inventory increased by $2 billion. Compare that to Q1 2025, where dealer inventory actually saw a slight decrease of $100 million. So I have to ask the hard question, is this true end-user demand, or is this just dealers temporarily restocking the yard? If dealers are just stuffing their lots because global supply chains finally eased up, what happens next quarter? They stop ordering, and that beautiful 38% revenue jump turns into a total brick wall. That is exactly how a cyclical trap is set for retail investors.
Okay, that's a very valid risk to watch, and we have to respect the inventory cycle. But you cannot ignore where the true structural demand is hiding right now. Let's shift over to the power and energy segment. What's absolutely fascinating here is that Caterpillar isn't just about moving dirt anymore. Their large reciprocating engines and massive turbines are heavily benefiting from this crazy surge in data center construction and oil and gas compression. Consider this for a second. A single large AI data center can consume as much electricity as a medium-sized city. They need massive, perfectly reliable backup generation, and Caterpillar is supplying it. They are literally powering the AI revolution from the ground up.
And the numbers completely back it up. Power and Energy delivered $7.03 billion in top-line sales. That's a 22% growth year-over-year, largely driven by $840 million in higher sales volume. Segment profit also climbed a very respectable 13% to $1.45 billion. Market skeptic. Yes, revenue is definitely up, but look closely at the profit margin right there. The profit margin actually contracted by a full 1.7 points, dropping down to 20.6%. Why is that happening while sales are booming? Because they had to absorb $346 million in unfavorable manufacturing costs. So while they are successfully selling way more of these complex turbines to these massive data centers, it's actually costing them significantly more to build those units. That margin compression, that is a major red flag for their pricing power moving forward.
And if you want to talk about glaring red flags, we absolutely have to hone in on the resource industry segment. For retail investors looking at Caterpillar as this flawless, unstoppable machine, this is exactly where you start to see severe structural stress. This segment covers the massive mining equipment. Those trucks the size of houses, and the foundation here has some very, very serious cracks.
You have to check out this divergence because it is staggering. Resource Industries actually managed a 4% revenue increase in Q1, bringing in $3.79 billion.
But despite selling more equipment, segment profit absolutely plummeted by 39%, dropping to just $378 million. You cannot afford to ignore this. That completely crushed their segment margin, bringing it down a full 7 points to a weak 10%. Listen, selling more heavy mining equipment doesn't matter one bit to your portfolio if the profits from those exact sales are collapsing by nearly 40%. The efficiency here is completely breaking down.
Okay, I hear you. That 39% drop in resource sellers' profit is a heavy hit, and it absolutely warrants a deeper look. So, we need to have a serious margin debate right now. We have to stress test this cost drag across the broader enterprise and identify the exact source of Caterpillar's rising internal friction. Why are margins getting squeezed so hard in specific areas even as total top-line revenue explodes?
Well, the answer is buried right there in the SEC filings. I'll present the hard data neutrally here. Caterpillar is facing a massive, unavoidable headwind from unfavorable manufacturing and tariff costs. In construction industries alone, this cost them $362 million. In power and energy, it was another $346 million. Add in the drag from resource industries, and you are looking at well over $708 million in unfavorable manufacturing and tariff costs eating directly into Caterpillar's foundation in just one single quarter. This is exactly why macroeconomics matter to your individual stock picks. Global trade friction translates directly to over $700 million vanishing from CAT's bottom line.
And when you pull back to look at the entire enterprise level, you see the true damage. The GAAP operating margin actually contracted from 18.1% in Q1 2025 down to 17.7% in Q1 2026. And it's not just tariffs either. SG&A, which is selling, general, and administrative expenses, basically the day-to-day overhead just to keep the lights on and run the business, shot up to over $1.81 billion. Meanwhile, R&D increased to $537 million. This potent combination of rising internal overhead expenses and massive external tariff costs is actively contracting the operating margins. For anyone holding the stock at its peak valuation, that margin squeeze is a glaring red flag for future quarters.
Those are very real headwinds for sure, and the tariff drag is undeniably painful. But let's pivot back to the bull case here and focus on the absolute ultimate metric for Wall Street. When you cut through all the accounting noise of margins, tariffs, and overhead, you have to look at pure cash generation and how executive leadership is deploying that capital. Seriously, when you want proof of strength, look at the cash. In Q1 2026 alone, Caterpillar forged $1.9 billion in enterprise operating cash flow. They ended the quarter sitting on an absolute war chest of $4.1 billion in enterprise cash. This proves that despite the margin friction and the tariff costs you just highlighted, the underlying business model is so robust that it is throwing off massive, undeniable liquidity month after month. And they aren't just hoarding that cash in some vault. They are aggressively rewarding shareholders. In Q1, they deployed a staggering $5.7 billion. That breaks down to $700 million in dividends. And keep in mind, they just announced another 8% dividend hike to $1.63 per share, staunchly maintaining their dividend aristocrat status. But the real story is the $5.0 billion they spent repurchasing their own common stock. That is a massive vote of confidence from management.
Is it a vote of confidence, or is it financial engineering? Let's break down the math for a second. Buying back stock reduces the total number of shares available on the market. That means when you divide the total earnings by a smaller number of shares, your earnings per share artificially goes up. In fact, Caterpillar actually noted a $0.13 per share favorable impact just from this lower share count. Buying back $5 billion in stock at peak valuations right after a 44% year-to-date surge is a highly aggressive capital allocation strategy. If we are actually at the top of the industrial cycle, deploying $5 billion into buybacks just to boost EPS, instead of, I don't know, shoring up that 7-point margin collapse in the mining sector, that might be a massive misstep.
Well, that brings us to the moment of truth. We need to synthesize this full fiscal picture into actionable intelligence. On one hand, we have record backlogs, massive cash generation, and a huge AI data center tailwind. On the other, we have real margin pressure, tariff costs, and some serious inventory risks. Right now, the broader market consensus reflects this exact tension. Caterpillar is currently sitting at a Zacks rank number 3. For the layman, a Zacks rank number 3 essentially means Wall Street is saying hold. Don't necessarily sell it if you own it, but don't rush to buy more until we see how these headwinds play out.
So, we have to ask the ultimate question for our viewers' portfolios. After drilling deeply into all this Q1 and Q2 data, is CAT a solid structural play you can confidently buy and hold forever? Or is it a cyclical trap built on temporary dealer restocking that's about to roll over?
Let's review the final blueprint side by side to make that call. The bull foundation is clearly built on that undeniable $63 billion backlog and the very real, very lucrative secular growth from data center turbine demand in the power segment. Plus, that $5 billion in stock buybacks mathematically creates a hard floor for the stock price, as the company essentially acts as a guaranteed buyer for its own shares. But the bear friction is intensely real. We have elevated dealer inventory heavily driving the construction volume, a $700 million plus tariff cost drag actively eating into margins, and rapidly shrinking mining margins in the resource segment.
So here is our final iron financial verdict. Caterpillar is an absolute industrial juggernaut, but at a 44% premium this year, absolute perfection is already priced in by the market. If you own it, enjoy the 8% dividend hike and that structural buyback support. But if you are looking to deploy new capital today, you must watch the dealer inventory levels in the next quarter. If end users don't clear those yards, the cyclical trap is going to spring.
Exactly right. Cut through the hype, respect the reality of margin contraction, and always demand hard data before you buy at the absolute top of a cycle.
That's how you forge a stronger portfolio. Thank you for joining this Iron Financial Explainer. So what do you think? Are tariffs and inventory going to crush CAT's momentum, or will data center demand bulldoze the bears? Leave your thoughts below, hit subscribe, and we'll see you in the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.